So here's the latest this morning. Investors weighing potential changes to the Fed's board as President Trump moves to fire Governor Lisa Cook ahead of next month's policy meeting. Jim Bianco of Bianco Research joins us now for more. Jim, welcome to the programme, sir. It's been too long. Do you think this market's underplaying the seriousness of what's playing out in Washington?
Over the near term, no, because I don't think what happens with Fed Governor Cook in the, between now and the September meeting is going to change the outcome of the September meeting, whatever the Fed decides to do. And it looks like they're going to cut rates at that meeting. As you get into next year and you get a new replacement for her and the president now has 4 governors, that could play out in the markets, but that's probably a 2026 story for right now.
Well, Jim, can we sit on the 2026 story? How do you think this might play out relative to what's already priced?
Well, the big thing about this is, we have to go back and look at the Federal Reserve Act and remember that all the Federal Reserve Bank presidents, their terms all expire at the end of February of 2026. They expire every 5 years. Now their boards reappoint them, and the Federal Reserve governors have to approve all of them. Well, if President Trump has 4 governors in place by February of next year, he could have the ability to have them veto any Fed president that he wants and basically kick them out. So we could start to see them start to change the makeup of those district presidents and who's in and who's out starting as early as next year. Now, that's a scenario that could play out, but it's not for sure that that is the scenario that will play out.
Well, I was going to say, Jim, John has made the point this morning that the list of candidates we've had for Fed chair have been very credible. Those that have already been appointed by Trump, very credible. Waller, Bowman, how big of a risk is that really?
That's the question. If we get a credible candidate that looks like they could be independent, and they could, judge where the economy is and what is the appropriate level of policy, then it won't be a big issue. If we get a candidate that doesn't look very credible and would bend to political wishes and try and, change the board mix to accommodate an easier Fed policy, that could be a problem. So it's all still kind of in flux. But right now, you're right. The most likely candidate that will replace Lisa Cook will be the next Fed chair. And all of the candidates that we have, or at least we're talking about, seem to be fairly credible.
Jim, just to play devil's advocate, we are dealing right now with a deficit that is at wartime levels, the highest since World War II. You continue to see borrowing costs move higher because of the movements in this bond market. Why not have a Fed and Treasury that works more closely together? Why not allow the Fed to not necessarily get rid of independence, but work more closely with other parts of this government, just considering the scenario that we find ourselves in?
That's referred to as fiscal dominance. And what that means, of course, is what you said, is that why doesn't the Fed make it easier to pay for government by lowering interest costs so we could have more government? And then if you follow through with that, the Fed could never raise rates ever again, even if we were to get inflation. And that would be a real problem. It would work for a while as long as you don't have inflation. But when you have inflation, the argument would be you can't raise rates to fight inflation because it will raise the borrowing cost of the government. And that's how you get spiraling out of control inflation. So such a move would be something that would end badly. It would only be a question of when it would end badly.
Jim, it doesn't have to be that drastic. I want to pick up on a line of thinking that Dani introduced just last week. If you just look at monetary policy, if they think about the efficacy of their policy at the moment, if they begin to drop interest rates, but you actually see long-end rates stay higher or maybe even creep higher because of what's happening worldwide, don't they have something to think about there anyway? Don't they have to think about what to do at the longer end of the curve?
I think they do, and I think they should, and the recent examples show that. We all know last year when they cut rates, the long end of the yield curve in the United States rose. You can also look at the ECB. President Trump likes to talk about they're cutting rates all the time, and we're not. The long end of the German Bund market or the French oat market is going up while they are cutting rates. Same thing is happening in the UK. And if you want to go even shorter term, since August 1st, 1 minute before the payroll report, the 30-year yield was 491. It's 492 right now. So for all the talk that the Fed's going to cut in September, the bond market's had a month to think about it, and it's up 1 basis point. So it's really trying to signal here that maybe it doesn't want these rate cuts, but it's probably going to get them anyway. And yes, the Fed should be looking at all of these signals from abroad, from last year, and what the current long end of the yield curve is doing now, and really question whether or not it is the right policy, because the bond market does not seem to be on board with it.
Jim, are you questioning as to whether it's the right policy?
Yes, I am. I don't think it is necessarily the right policy. I think we're going to see inflation from both goods prices from tariffs and the population growth slowing because of the slowdown in immigration is going to put wage pressure on the existing jobs that we have right now. And that combination is going to push inflation higher. Now, maybe because the border is closed and immigration is down, you'll see some slowing of the economy, but you might more than offset that with higher inflation. And that's where I think the Fed is going to have to think twice about whether or not they should be cutting rates.
Jim, we were just talking with Bill Dudley, though, who would agree with you that inflation potentially is a bigger problem, but made the argument 25 basis points of a cut in September, that's not necessarily an issue. Do you think it is an issue if they cut in September?
It is an issue if the argument is here's 25 to get President Trump off their back. That's a political move. But if they cut in September 25, you'd have to presume what Chairman Powell has said, that they are restrictive, that the Fed dot plot says that the neutral rate is somewhere around 3%, and that this is the second leg down in interest rates to eventually get them to neutral, and that they're going to keep going. Otherwise, like I said, if the argument wants to be, oh, it'll be a one and done thing just for political purposes, I don't even think that's even a good argument as well.
Jim Bianco, I remember when your name was in the mix to be a Fed governor, and you're a very credible guy. Appreciate your time. Jim Bianco there at Bianco Research. It's good to see you. Lined up to be a Fed governor in the last few years and didn't happen. We prefer Jim where he is and we get more access.
Yeah, but it would have been nice also to have Governor Bianco. I think we all would have enjoyed that.
Wouldn't that have been cool? Want to mix it up a little bit?
I'm sure he still would have joined the program.
End the groupthink? I'm sure he would have. Get live call-ins after the decision.
Oh, yeah, I like that.
Just really shake things up.
Yeah.
Not that they're allowed to do that, but we can change the rules.